All right. Well, welcome to our Boeing Financial Planning Workshop. My name is Dave Mantell. I'm a certified financial planner and partner with Stabler Wealth Management, the Boeing retirement specialist. We're an independent financial planning firm and investment management, and we specialize in working with Boeing employees to help our clients prepare for, transition to, and succeed in retirement. Now, diving into today's presentation, we'll be reviewing how to look to maximize your Boeing 401k benefits, as well as what the Mega Backdoor Roth is, and if that's a tool that you should be using in your 401k. So during the presentation, if you have any questions, make sure to send us an email. You can email Sean from our team at sean@stablerwm.com. And then Sean will be fielding, collecting any questions that come about, and we'll look to address those at the end of the presentation. And so for today's agenda, we're going to focus on three main items. The first of which will be an overview of Boeing's 401k benefits and how to look to maximize those. The second item we're going to look at is what is a Mega Backdoor Roth, and is it still available and something we should be doing? And then lastly, we'll look at recent changes to Boeing's 401k program. At the start of the year, of course, that moved to Fidelity, which came with some other changes. So we'll hit on a couple key items on there to be focused on. So starting with an overview of Boeing's 401k benefits. So in your 401k, there's several different contribution options that you can choose. So first off, you have the pre-tax or the Roth contribution option. With this, you're able to do up to $20,500 a year to either or a combination of those two buckets. And then if you're over the age of 50, you could do an additional $6,500 catch-up. So that totals $27,000 you can do in a year 2022 in total. Once you fill up either the pre-tax and or Roth option, you then have the ability to do the after-tax contribution at Boeing. So this is pretty unique. Most 401k plans do not offer this after-tax, but basically it allows you to put extra funds in on top to your 401k. And in total, between pre-tax, Roth, after-tax, and what Boeing contributes, you can do up to $61,000 in 2022. And then if you're over the age of 50, you could do another $6,500. So a total of $67,500 into your 401k each year, which is pretty powerful, of course. Again, as I noted, this limit includes what Boeing puts in. So that may level out the amount you could put into these buckets to not supersede that amount. In the next page, I'll go over all these options further, along with the SSP, which is another way to add additional to your retirement benefits amount on top of the traditional 401k that I just went over. Yeah, one last thing to mention is when you look at the pre-tax, Roth, after-tax, and totals, you could see these little bubbles added. And so, for example, last year you could do $19,500 in your 401k pre-tax Roth before catch-up. That went up $1,000 to $20,500 that I noted. And then for the overall limit, which includes after-tax and Boeing's contributions, that went up $3,000 last year to $61,000 in total. So again, that's inclusive of the $20,500. And so again, a really powerful amount that you can put in each year to really supercharge and set up your retirement. So diving into those different categories, there's a whole host of options to be looking at, right? And so the first off is that traditional 401k, the pre-tax option. And so what that means when you do the pre-tax is any contributions you put into your 401k reduces your taxable income today. So if you put $27,000 in your pre-tax 401k, so the max with the catch-up, that does not show up on income as your tax return, on your tax return. So you are not paying income tax this year on that amount. Any future growth, until you take money out, there's no taxes either, which is called tax deferred. But when you take funds out in retirement or down the line when your family inherits the funds, for example, then it's all taxed as ordinary income. Since you didn't pay tax up front and you're not paying tax as it grows, That traditional pre-tax bucket, when the money comes out, it's all taxed as ordinary income. The Roth option's basically the opposite. So money that you put in the Roth 401k, when you put the money in, it doesn't save you any on taxes today, of course, but all the future growth on that, you never pay tax on as it's deferred or when you take the funds out. Likewise, your family can inherit it. Your spouse has their own Roth IRA, Roth 401k, and then your children as an inherited Roth and continue to defer the tax for a number of years as well. And never pay tax on that when it comes out. So same concept. Okay, so those are the two traditional ones. So again, between the two, you could do $20,500 a year, and plus the catch up if you're over 50, a total of $27,000. Once you maximize those two buckets, Boeing has this additional after-tax option that I mentioned. And so this is after those other two categories, you could put additional funds into the after-tax amount. And the way the after-tax works is money that you put in the after-tax does not reduce your taxes today like the pre-tax. The growth is taxed as ordinary income when it comes out. So while the money that you put into the after-tax, when you pull that out, you're not paying tax on the principal, but all the growth on it over time, when you pull money out of a 401k, is taxable as ordinary income. And so it's a little bit different than those other two vehicles. And I'll hit on this a little bit later, but where the after-tax is really powerful is when you contribute money to the after-tax, you can then convert that to a Roth right away. And so it's a way to get extra money into your Roth account, which is still an available option currently. So I'll go over that in a bit. And so again, after you fill up that pre-tax and Roth bucket, you know, the 20,500, 27,000 with catch up, then you could put additional up to that 67,500 with the catch up. So that extra can go in that after-tax bucket to hit those higher numbers. So once you fill up all three of those buckets, Boeing has something additional called an SSP. So a supplemental savings plan. And really what this is, it's what's called a deferred compensation plan, where Boeing allows you to defer more of your salary, put extra into this SSP plan. So when you put funds in, it doesn't show up as income today, and it grows tax deferred, kind of like the pre-tax account. And then when the money comes out, it's taxed as ordinary income. Couple real considerations with the SSP. So each year you have an election period where you decide if you want to make contributions that year. And then once you decide that, you can't change it that year. You can't change your 401k contributions either. So it's pretty inflexible and you're locked in. Additionally, you can't have much control on when the money comes out. So with the SSP, there's also a schedule you elect in terms of how that money comes out in your retirement years. And again, you only have one chance to change that. So it's not very flexible. So there's not a lot of control as to how it comes out. Because traditionally with your 401k, like your pre-tax, Roth, after tax, once you're 72, you have to start taking draws out. It's called an RMD, required minimum distribution. But any age after 59 and a half, you could take funds out without penalty. Similarly, if you retire at age 55 or later, you could take it out before 59 and a half without penalty. So that's a much more flexible withdrawal scheme versus the SSP, where it's more fixated on how the funds come out. But that is an option. And then lastly, on the SSP, this is not part of the 401k. It's different. This is what's called a deferred comp plan, deferred compensation. So you have Boeing company risk. What that means is if Boeing ran into financial woes and there's concern about their solvency over time, they need to be able to pay out that deferred comp, right? It's on their general ledger, while the 401k is all protected money. You know, that's separate. That's your money. Boeing's not, you know, holding that for you in a sense. Okay. So when you look at all those categories, there's quite a few. The question we get a lot is, okay, should I do the pre-tax or the Roth 401k? Which one's better? And this is entirely depends on your personal situation. One thing to think about is, okay, what's my current tax brackets versus future tax brackets? And so if you're going to be in a higher tax bracket now than you are when the money comes out, A lot of times it's advantageous to put money in the pre-tax option, reduce your taxable income today, and then in retirement, when you take the funds out, you could be in a lower tax bracket, right? So you're saving more up front, and while you're paying tax when it comes out, it's at a lower tax rate. Something to keep in mind, though, is we currently have very favorable tax rates, which I'll show you on this next slide here. And so even though you may be in a much higher income position during your working years, even if your income's lower in retirement, you may look at it and say, well, the tax rates could be quite a bit higher. So I'm actually in a higher tax rate potentially down the road than I am today. And remember, between your 401k draws, again, at 72, you have to take draws from those retirement accounts, from your pension if you go that route, or lump sum pension, if you take that and defer it, that will be subject to RMDs as well. Social Security, a lot of folks are surprised they're at a pretty high level of income even into retirement. And so again, you have to do a little bit of planning here and work with your financial planner to map out the right strategy for you. As noted, look at your other retirement income sources, right? If you have pension, Social Security, those RMDs, required minimum distributions I mentioned, it may be very beneficial to start doing more Roth, building more diversity in your tax character buckets. So you don't have everything where when you take funds out, it's gonna be taxed as ordinary income. And in addition to protecting you from higher tax rates down the road, in retirement, you may at some point need to pull out a big chunk of money for a car or a home project. And it's nice to have some other buckets where you're not paying ordinary income tax on every dollar you take out on top of what your ordinary income can be. So tax bucket diversity is a big one. And then the tax rules are always changing, right? So something we really like to look at as part of your estate plan is what we call family tax bracket management. And so, for example, when you think about it, you have certain funds right in your retirement investment accounts. In a lot of cases, as part of your plan, your family may look to be inheriting a large portion of these, and that might be very important in certain situations as well. And so recently, starting in 2020, we had a new act, a tax bill called the Secure Act, which basically changed how inherited retirement accounts work. So before this new act, when your children, for example, inherited your 401k or IRA, they were able to stretch out the draws and therefore the taxes over their entire lifetime. More recently with the Secure Act, while when your spouse inherits it, they can continue it as a traditional 401k or IRA. When your heirs, so your children inherit it, they now have 10 years to draw the funds out. They can't stretch it out over their lifetime. And so if part of your plan, if you have, $2 million between lump sum and 401k and kind of a deferred retirement account, and let's say you have two children that inherited in that way, not to mention future portfolio growth, that could be a very big tax burden on your family, given they'll have much less flexibility on how to draw the funds out. So again, as part of your estate and family plan, that's something to be looking at as well. So again, discuss it with your financial planner. It's very personalized what the right decision is, but the Roth can be a very powerful tool and complement your other accounts in a big way. Even if you're a high earner, it still can make sense. Yeah, so I noted tax rates, right? So even though you may be in a higher income level now, we have pretty darn advantageous tax rates. And so currently, so on the left side, this is the current tax rates for a couple married filing joint. And so this is taxable income. So before you take any deductions on your tax return. And so 340,000 of taxable income for a couple. So before deductions, that could be 365,000 or more of gross income. You're only in the 24% ordinary income tax bracket, which again, from a historical perspective is very favorable. Even if we don't get any tax law changes, which is very possible, again, part of the Biden tax plan was changing the tax rates pretty substantially. Nothing's been passed yet, but even if we don't get any tax law changes, at the end of 2025, the current tax laws sunset, and we go back to what they were before the Trump tax law changes. which is the right side of a table. And so typically most of the brackets, you're seeing a 3+% increase in tax rates, at the same income level, for example. But there's a couple levels, for example, in that 230,000-ish, plus range, where you could be paying only 24% ordinary income tax right now. And that could jump up to 33% without even any tax bills being passed, right? This is just at the end of 2025, the current tax law sunset and go back to the prior rates. And so that's nearly a 10% tax rate increase. Not to mention, just like we have very low interest rates currently that are going up, same thing from a tax perspective. We have very low tax rates historically currently. And we don't know when they'll go up or where things will land, but similarly, the direction things are going, our hunch is we are likely looking at higher tax rates down the road. And so we know in the coming years, that's probably, going from 24 to 33%. But, there's been times in history where tax rates are much, much higher. And so again, having diversity in retirement buckets, having some funds where when you take the funds out down the road, you're not paying ordinary income tax on those, can add a lot of flexibility in retirement and is a really important thing to be looking at as you start to craft your retirement picture and decide, should I be doing pre-tax, Roth, should I do after tax, that type of decision. Okay, so the Mega Backdoor Roth, this may be something that you've heard of that I'll go into a bit more. But this is, again, a unique strategy using your after-tax 401k dollars at Boeing to really supercharge your retirement. And so as noted, the 2022 normal contribution limit is $20,500 into either your pre-tax or Roth buckets. With catch-up, that's $27,000. However, you could do additional contributions into your after-tax bucket that take you up to $67,500 if you're 50, including what Boeing puts in. And so for many folks, that could be an additional 20, 25,000 plus you could put in your after-tax, allowing you to put upwards of 50,000 plus what Boeing puts in each year, depending on your income picture, into your 401k, which is very powerful. And so the way the after-tax works is once money's in your after-tax, you can convert it to your Roth IRA right away. And so if I put 20,000 in my after-tax this year, again, if I just left that in my after-tax account and growed it there, all the growth would be taxed as ordinary income when it comes out, the highest tax rates. If you're after-tax, once you contribute to that, if you move that and roll it to a Roth right away, then all the growth will be in that Roth character, and you will never pay tax on that, you or your family, on the after-tax contribution or the growth. And so that's a very powerful thing to do. And again, a mechanism where with what Boeing puts in, you could be adding $67,500 to your 401k each year if that fits in your picture. Again, not that you need to do that, but again, that availability is there. So currently, the way it worked before the move to Fidelity is that if you converted that after tax to a Roth in your Boeing 401k, when you did that, basically it wasn't automatic, right? And so when you specified that, all the growth on the after-tax contributions as they happened would be taxed as ordinary income. And so, for example, if I had 10,000 in after-tax, and you didn't want to every paycheck, convert it over, right? There's kind of a limitation and time limitation on doing that. When, let's just say at the end of a year, you converted your after-tax over and you put 10,000 in after-tax, it grew to 12,000 with market performance. If you do that inside of Boeing, it used to be, you'd have to instruct it specifically. And then all the growth, that 2,000 of growth on the 10,000 you started with would be taxed as ordinary income when it happened. And so a really powerful strategy is you can actually roll your after-tax dollars, even if you're not 59 and a half yet, you could roll those to an outside Roth IRA, and all the growth on the after-tax would not be taxed as ordinary income. What would happen is when you rolled it to a Roth IRA outside of Boeing, you would get two checks. One for your contributions to the after tax, which would then go into your Roth account and be able to grow there. And then the second one would be any growth on the after tax contribution would be a second check, which you could then put in your outside IRA account. So if you had an LPL in our case, or a Fidelity Roth and IRA, you could roll it outside there without any tax implication to do that. Again, if you have a lot of accrued after tax, you don't want to convert that at Boeing, because what will happen is all the gains on the after tax will be taxed at ordinary income at that time. So it's a powerful way to kind of roll it outside of the account. With the change to Fidelity, you do have the option where you could direct for Fidelity whenever you contribute money to the after tax, that to automatically be shifted to Roth. So our understanding is that is an option to do. However, in a lot of times, you may still want to roll your after tax outside of Boeing to your outside Roth IRA. For example, in outside Roth, if you're younger, you don't have to wait till 59 and a half to access it. Once that Roth is converted or rolled to an after tax rolled to an outside Roth, after 5 years, you can access those funds. And so if you're 40 years old, 45, working at Boeing, if you roll your after tax to an outside Roth IRA, that's additional tax-free funds that you can have access to. And, again, it's a good place to grow that money, but it's another, free account where if you need to, update a roof or purchase a vehicle or something comes up, but you don't need to tap that money out of your 401k and pay penalty. You can access it out at an outside Roth. So that's, again, a lot of strategies here. This stuff is pretty nuanced, especially when rolling it outside or doing that after tax to Roth conversion. We definitely suggest, kind of going through it with your financial planner to review it, to make sure it's done appropriately and nothing's triggered. But this is absolutely something that you can do, and we'd be happy to look at and review with you as well. It's a really powerful strategy, this Mega Backdoor Roth. Okay, so we've been receiving a lot of questions saying, wait a minute, you guys sent an article last year saying the Mega Backdoor Roth may be going away. What happened? I thought we had to get it all out of our after tax, by the end of last year, because the government was basically shutting down that option, the IRS. And so as part of Biden's Build Back Better tax plan, that was really one of his key, initiatives when he was running. One of the kind of, things that they were taking out of that was the ability to convert after tax to Roth. So they were basically closing that option where you could eliminate doing the Mega Backdoor Roth or even a traditional backdoor Roth IRA. And so all the expectation was, with it was looking like that tax bill was going to be passed last year in 2021, the expectation was that would be a closed door option. We wouldn't be able to do it starting in 2022. Amazingly, a couple of the more kind of moderate senators really dug their heels in here. And as a result, we have not seen any tax law changes yet. Nothing has been passed. This is still on the table. There's a possibility that this new Build Back Better plan and the closing of the Mega Backdoor Roth could be passed this year. We have midterm elections coming up later this year, right? And so we have a small window where the Democratic Party has a majority and the ability to put these tax law changes through. But again, it's been a real challenge, and it's really up in the air whether that happens or not, or if closing the backdoor Roth ends up in the final version if it is passed. Therefore, where that leaves us is right now it's still available. And so we do think, again, confirm with your financial planner or tax professional, this is something to continue to be looking to do. There's a good chance this may be gone next year. So it's kind of, getting it while it's still there. But currently, per the tax laws, this is something that you can be doing. And it'd be pretty difficult likely to make a retroactive change where a bill's passed that says, hey, starting January 1st of this year, you can't do a Mega Backdoor Roth. Because at that point, funds have already moved to after tax to Roth, and it's happened. A lot of the tax pundits think this, if it did happen or pass, getting rid of this, I'd probably be more forward looking. But again, anything's possible. So it's important to keep the information flowing, Be really nimble here and again, map out a plan with your financial planner on this. But currently, the Mega Backdoor Roth, the door is open. So something to really be looking at and focusing on as a very powerful tool. So another question we get, once I max out my 401k, then what? So let's just say, some folks are really filling up all those buckets. They're doing the maximum. What's the next best place to save? What should we do? And again, a lot of it's really situational. Once you fill up that pre-tax or Roth bucket, again, the after-tax is a good option there. As I noted, I'm generally not the biggest fan of the SSP deferred comp, given the limited flexibility. You can do a health savings account, which is a really neat option. I'll go into that a bit more on the next page. And additionally, you could contribute to a Roth IRA outside of your 401k, for example, at your LPL Roth or Fidelity Roth, depending on what your income level is. So again, that's something to review if you're a financial planner, but you could do additional to an outside Roth potentially as well. And then on top of that, having a normal, traditional, non-retirement investment account. So again, account outside of your 401k provides a lot of flexibility as well. Those types of accounts aren't as tax advantaged, right? You're still paying tax on dividends and capital gains as you realize your investments or sell things at a gain. But those are good flexible accounts. Capital gains tax rates are less than ordinary income currently. And then on top of that, it's nice to have a good flexible bucket where, especially in retirement, for example, you have places to go where you're not taxed on ordinary income when the money comes out. That just provides you a lot of flexibility there. So that's a good option as well. Yeah, quickly, a health savings account. Again, if you're eligible based on your Boeing health insurance plan, that's a really powerful item to do as well. A family could contribute up to $8,300 a year if you're 50. That includes that catch-up amount. Basically, the way a health savings account works is money that you put in your HSA account reduces your taxable income. So kind of like a pre-tax 401k contribution, it reduces your taxes today. You can invest some money, and all the growth when you take it out for health expenses is tax-free as well. So it's really best of both worlds. Money that you put in, you save taxes on, and then all the growth you don't pay tax on either, as long as it's used for health purposes, health expenses. You're gonna have a chance to use it. It can be used on Medicare insurance premiums. There's just a real wide range. So this is a really powerful tool for those that are eligible based on your health insurance plan. And I should note that 8,300 max for a family, if you're over the age of 50, that includes what Boeing contributes as well. So Boeing's putting in your HSA plan that's less that you can contribute to total that 8,300. Okay, yeah, a couple items on the new Boeing 401k retirement plan. As I mentioned with the change to Fidelity, we've seen a couple of changes there that I wanted to hit on briefly. Now set up with Fidelity. For non-union employees, there's a change to the company match and contribution plan. So now how it works is before Boeing was doing a match, basically up to 8%, right? 75% on the 8% that you put in, so 6% match. And then on top of that, they were doing an extra contribution, an age-based contribution. That age-based contribution is going away, but instead Boeing's now matching dollar for dollar up to 10%. So it works out about even. On top of that, for 2022 and 2023, as they sort of wean off the old program, in addition to a 10% match, they're putting an additional 2% contribution on top of that. And so again, non-union employees really suggest contributing at least 10% if you can to get that match. It's kind of free money from Boeing, right? In addition, they've added a new true-up contribution. One frustrating item before was if you really went heavy on your contributions early in the year, and let's just say you maxed out your 401k come September, October, November, December, you'd miss out on the match. It was kind of, hey, we'll match each paycheck up to that amount that you put in, But once you stop contributing, if you filled up your buckets, sorry, you're not getting a match from Boeing. And so with the change, they're now doing a true up contribution where even if you fill up your buckets early on, they will make you whole and put extra in to account that you did the entire contribution amount. So they're going to match the full 10%. Something to note, there is a contributions hierarchy now. So currently, when you make your contribution elections to your 401k, you basically say, I'm going to do pre-tax or Roth. And how much am I going to do into each? Once that 20,500 bucket fills up for the combination of pre-tax and Roth, then they move to the catch-up if you're over the age of 50. So then it fills up that catch-up bucket. Once the catch-up is filled up, if you're still contributing, then it goes to the after-tax contribution. And so it makes it a little bit more simple. Before you'd have to say, oh, I want to contribute this percent to pre-tax, this percent to catch up, this percent to after-tax. So now it's more pre-tax or Roth, and then those bullets fill up in a hierarchy. And so I actually like this component. I think it's more straightforward, and that is a priority in terms of how you want to fill those. Fill the pre-tax or Roth first, and then do the after-tax thereafter. And then one more important item, log into Fidelity and confirm your beneficiaries are correct. We've seen a couple cases where they did not port over correctly from work life, or from the prior 401k plan, I should say. And so again, it's really important to make sure your beneficiaries are set up the way you intend them to. So double check that. And by the way, as you're doing that, talk to your financial planner, right? As part of your estate plan, there's a lot of strategies and thought that goes into how your beneficiaries should be listed for your different types of accounts to tie in your estate plan. And so, again, we've seen this goofed up over time. So you want to make sure you do it right, so you're not creating a big problem for your spouse, your heirs down the road. So that's something you really want to review as well with your planner. Yeah, so that is the material for today. I hope you found that helpful. We've got a lot of great feedback on these workshops, so we're going to keep them coming and try to be really regular with these. And so, it's something we're going to continue to do. We'll be hosting another workshop here soon, going over lump sum changes and retirement changes based on segment rates and kind of what we've been seeing with a lot of interest rate moves and moves with the economy. And so that's one to really watch for. And in addition to the virtual, we hope to start doing some in-person ones as well to complement that too. But again, stay tuned, just based on the environment and where things are, we're going to be really cautious there. We are offering a 1-hour complimentary financial checkup to review your personal financial picture. No cost, no obligation to do this. So I really suggest you take us up on it. Again, we've got really solid feedback on this. So we're happy to help. Again, about us, we're fiduciaries, we're independent financial planners. So the way that we operate is we work with our clients and serve as their financial planner, not only helping with their investment decisions and how to invest their accounts, but also mapping out how to plan for retirement, tax planning strategies, insurance, estate, and just making sure we're doing everything that you should be to maximizing your financial picture and doing what's best for yourself and your family. And so again, take us up on that 1-hour complimentary review. We're happy to do that. Yep, so we'll be reaching out. You could contact Sean O'Connor from our team as well. His phone number is noted here, as well as his email, sean@stablerwm.com. So it's something we really encourage you to take us up on. And then you could also find us at our website. Again, we focus on Boeing, folks. That's really our bread and butter. Go to planyourboeingretirement.com. That'll take you to our website. And we will be posting this webinar and other materials there. So definitely suggest checking it out and passing it on to any colleagues that might be interested in the content. Again, yeah, we're happy to add anybody to our communications list, include them in other workshops that we do. So have them check out our website, or we'd be happy to contact them as well if you want to pass on their information. We had a couple questions come up during the webinar, so let me make sure to hit on those. I got a question. I thought the ability to convert after-tax 401k to Roth IRA or Roth 401k went away. As I noted, this has been on the chopping block with the recent tax proposals that have been out there. Nothing has been passed yet. So currently, this is a wide open option that we do think it makes sense to take advantage of. As noted, we can see changes where this goes away down the road. So it's important to stay really clued in on this. So you're adaptive as those changes, if any changes happen. But currently that is open and a very good strategy. Another question, should I hold off on contributing to my after tax until whether we know if the tax laws are passed or not? Again, I'd review this with your planner or a tax professional. Again, currently it's an open available option. So I do think in most cases it makes sense to do, but it is good to have your finger on the pulse so you're able to adjust and adapt if that option does go away in the future and the tax laws do change. So stay tuned on that one. Well, yeah, again, really appreciate you taking the time to join us. I hope you found this helpful. We'll keep the information coming. Reach out. We'd be happy to meet with you and provide a second opinion, do that financial planning checkup. And we'll continue to let you know as we have other events and information coming down the line that we think will be valuable to you. So yeah, look forward to staying in touch and have a good rest of your day. Take care.